Hey YouTube, this is Dana, and welcome to Now You Know. Today I'm going to be talking to you about a loan amortization and how it actually functions and how it does not work in your best interest. And speaking of best interest, I've also done a blog about loan amortization that I will be putting in the description below. So today we will look at a $250,000 loan. The loan interest is 3.75%. It's a 30-year fixed loan, and you'll be paying the loan for 12 months out of the year. And for this illustration, just for a point of reference, we'll have it starting on the 4th of September of this year. Now, with that, you will have a scheduled payment of $1,157.79. If you pay on time, which we expect you to do, you will be paying for 360 months, and your total interest will be $166,804.03. Now, that's one thing they do not tell you. Now, if you look over on the payment, on the first payment that we're going to be making in September in a couple of days, the beginning balance is $250,000. The scheduled payment, which is principal and interest only, is $1,157.79. Now, I will also include a link in the description below that talks about the additional payments that you would be making in addition to your mortgage payment. You have the total payment here, and out of that $1,157.79, only $300 of that amount goes towards your principal, and the remaining balance goes towards your interest. So in your first payment, your $250,000 loan is now $249,623.46. It barely moved. Now, you'll say, well, when will we start having more principal than interest? Okay, let's scroll down. Okay, this is September 2020. That's not going to happen until 12 years later. That's when you'll actually be paying more in your principal than you will in your interest. Quite interesting. Now, let's say partway through, after about a year, maybe less, you're making your payments on time, and they come to you and say, hey, you've been making your payments on time. Why don't we give you a new interest rates to help lower your payment? And of course, they will tell you there will be a break-even point, but you will save a lot of money. Well, let's see if that actually will happen. Okay? Now, to make it really interesting, we're going to change this interest rate from 3.75 to 2.5. Let's make it worth our while. Okay. Let's see if they kept their promise. So instead of paying $1,100 plus dollars, our payment is now $987. They did keep their promise. And also the interest went down. So instead of $166,000, we're now paying $105,000, a little over that amount. Now, let's really make it interesting. Why don't we pay it off instead of 30 years? Why don't we get it down to 15 years? Okay, I'm going to change that 30. Let's change that to 15. Now, our scheduled payment went up significantly, but let's see what else went down. Our total interest went down, almost in half. But you're probably not interested in that because your payment is a lot higher than what you have budgeted. So what we'll do is we'll go back to the 30 years. We'll change that interest rate back. We'll change it back to 30 years. Okay. We have our scheduled payment the same as before, but now we're going to do something really interesting. We're going to change how the interest is captured. Because if you notice, it's heavy until you get to 12 years in. So let's go through and change the optional payment to $5,000. And I'm going to show you how to do that in a subsequent YouTube video. Okay, let's see what happens when we add an extra payment. Okay, our $250,000 stayed the same. Our interest rate of 3.75 stayed the same. 30 years. Payment every month. Now we're going to add an additional $5,000. That may seem like a large amount, but don't worry. In subsequent YouTube videos, I'm going to explain where that $5,000 is going to come from, and you'll be pleasantly surprised. Okay? Our scheduled payment stayed the same, but let's see what did change. Instead of 360 months, we actually are going to have our house paid off within 4 years. Instead of 30, we'll have it paid off in less than 4 years. And we'll be paying $17,000, little less than $18,000 of interest, as opposed to the former $166,000. Okay, remember the total interest right there? And you saved yourself $216,000. So here's a way to get almost $250,000. And like I said before, I will tell you in subsequent video where that $5,000 will come from. Thank you for your attention, and don't forget to share, comment, and subscribe.